Now that we've got an overview of the different methods, let's do an example that incorporates several of these methods and see how we would review a project to determine whether we want to go ahead with it or not. So here's an example, very simple. Let's suppose we're buying a machine. So in year zero, the cash flow is negative 50,000. So this is another way of saying that this is really just the cost of the machine. Okay, year zero is now. Now, 1 year from today, we expect to make $24,000. And then year two, we make 22, then 19.5, and then 14.6. Okay, so that continues on. So these are essentially cash inflows that we would expect the machine to generate in the future. And then in this case, we're assuming that it ends at year four, there's no more cash inflows, and maybe the machine is of no value, you just throw it away and it's not worth anything. So in that case, let's calculate the simplest thing first. How long does it take to do a payback? So I'm going to do a cumulative cash flow here and say at year zero, we have spent $50,000. Okay, however, by the end of the first year, we earned 24,000. So now we are only negative 26. Okay, so we have recovered 24 of the original investment. Then at the end of year two, we recover another 22. So we're only down by 4,000. Okay, but then the following year, we make 19,500 more. Okay, so we will be positive at this stage. So by this point, we are at 15,500. So you can see that at some point here, we have the payback. So the payback occurs when it's at zero, because you've recovered your full cost. So when is that? If I was to draw that in a line, I'm going to say at the end of year two, we're at here, and then somewhere between year two and year three is going to be the payback. And at the end of year two, the difference between this line here is essentially 19,500, because that is how much we earned in the third year. And at year two, we start off at negative 4,000. So in order to get to zero, we need to move 4,000 on the line. So if I was to put that in a formula, I would say that the payback is going to be 2 years, because it took 2 full years, and a portion of the third year. So it's not going to be the full third year, but a portion. So how much of the third year will it be? It'll be 4,000 that we need to get to zero, divided by the 19,500 that they earn in the third year. Okay, and that works out to 2.21 years. So what this says is that this machine, if the projections hold true, will repay the original cost within 2.21 years. Is that good or bad? That depends on your analysis on the risk of the machine and a bunch of other factors. But essentially, the shorter the payback, the better. Okay. Shorter the payback, the better the investment. The reason is because, first of all, for common sense, you want to get your money back as quick as possible. Also, if you think about it, forecast years 4 or 3, 4, 5 years from now tend to be less accurate than a forecast 1 year from now, just because there's more variables that could come into play.